you're thinking about looking for a big pullback to buy silver, think again.
Peter Schiff is pointing out something most investors are missing. Silver isn't volatile because it's weak, it's volatile at high prices, which signals consolidation, not collapse. While paper prices move around, physical silver is tightening and premiums keep rising. Wall Street is only starting to wake up because gold and silver refuse to crash, and the fundamentals keep improving. And behind the scenes, rising silver prices are quietly crushing gold miners' costs. This isn't noise, it's pressure building inside the market.
Silver's been a lot more volatile than gold all week. But the important point is that the volatility is taking place at these very high prices. And this is just another consolidation of this big breakout. So if you're thinking about looking for a big pullback to buy silver, think again. The opportunity to buy $50 silver is long gone.
What's critical to understand from this clip is not short-term price movement. It's where the volatility is happening. Silver isn't swinging wildly at depressed levels. It's fluctuating near historic highs, which signals strength, not weakness. When markets consolidate at elevated prices, it usually means sellers are exhausted and buyers are absorbing supply. This kind of behavior typically appears before another leg higher, not before a collapse. Many investors still assume silver must retrace heavily before moving higher. That belief is rooted in past cycles, but this cycle is different. Structural shortages, rising industrial demand, and years of underinvestment have changed the setup entirely. The cheap silver phase was the accumulation window. That window is now closing.
Because I think the supplies of silver are going to start to run low and the premiums are going to really start to blow out. So that even if silver goes down, the price of silver coins and bars may still go up. And in fact, most of the move on the week, this week, happened on Monday.
One of the most important points raised is the disconnect between paper prices and physical reality. Even if futures prices pull back temporarily, physical silver can continue rising due to premium expansion. This is not theory, it's already happening. When inventories tighten, dealers don't price metal based on charts alone. They price it based on availability. This creates a dangerous illusion for paper traders. The chart might show weakness while real-world buyers pay more than ever. That's a classic sign of a market under stress when price signals stop reflecting physical conditions.
Wall Street is starting to figure out that gold and silver aren't going to crash. And eventually, they're going to realize that they're going to keep going up. And they're going to keep going up because of the fundamentals. And the fundamentals are getting better and better for gold and silver with each passing week.
Why Wall Street is late again. Institutional money typically waits for confirmation. But by the time confirmation arrives, the easy gains are gone. Wall Street isn't starting to look at silver because it's cheap. It's starting to look because it refuses to go down. Persistent strength forces revaluation. Once large players accept that gold and silver are not crashing, capital rotation begins, and that rotation tends to accelerate quickly. Fundamentals don't improve gradually in commodities. They improve quietly, then suddenly become obvious.
Very few people seem to understand that gold companies also mine silver. It just reduces the cost of their gold. And now their costs are going to collapse because the silver byproduct that they're mining when they're looking for gold is now so valuable that it is dramatically reducing the cost of mining gold.
The hidden silver lever in gold mining. One of the most overlooked dynamics is how silver impacts gold miners. Many gold companies are also major silver producers, but silver is treated as a byproduct. When silver prices surge, it collapses the effective cost of mining gold. That means margins expand dramatically without gold prices needing to rise further. This creates a delayed effect. First, silver rises, then mining profitability explodes, and only later does the broader market recognize what happened. That's why mining equities often lag early and then move violently. The bigger picture most investors miss. Silver isn't moving because of speculation alone. It's moving because the system is repricing risk. Rising volatility at high prices, expanding premiums, tightening supply, and improving fundamentals all point to one conclusion: silver is transitioning from a traded asset to a strategic asset. That transition doesn't happen smoothly, it happens suddenly. And by the time consensus agrees, positioning becomes expensive.